Before we start, it's worth noting that whilst Ryan has been involved with Zilch from the very beginning, he's not one of the founders. His role has been centred on fundraising, strategic partnerships, investor engagement, and helping the company's growth narrative as the business scaled from an ambitious startup to one of the UK's leading fintech platforms. Today's guest is someone I've known and worked with for nearly 25 years. Over that time, we've had front row seats to multiple market cycles, the rise and fall and rise of stockbroking, public markets, private equity, founder-led businesses, venture capital, fintech, and now AI. I've worked with Ryan Mendy at various stages of that journey, from capital markets through to growth businesses, and now he's part of the UK's most successful fintech unicorn. Today, Ryan is Chief Business Officer at Zilch, recently recognised by Deloitte as the fastest growing fintech unicorn in EMEA for the second consecutive year. And he's also deeply involved with the broader UK fintech ecosystem through the Unicorn Council. But today isn't necessarily just about Zilch. It's about what we've both observed over the last 2 decades. Why companies ignite, why companies scale, and why incentives, trusts, and human behaviour matter far more than most people realise. Welcome to Ignite&Scale, Ryan. Great to have you on.
Well, that was a hell of a intro. I've got to admit, it's been an interesting quarter of a century, the last 25 years, since we all met. But look, that Mike, great to be here. And firstly, thanks for having me. It's a great show. I think you even had our esteemed friend, the one and only NS Neil Shah, on before. I think he'll, like an ALS challenge, called me out as well. Thankfully, I haven't got to do any ice bucket or I haven't got to do any press ups.
Well, you don't know.
Now that will be an interesting podcast, especially for anyone listening that isn't watching. So we can pretend we're doing pull-ups. No, look, genuinely, look, I just reflect maybe a couple of points, maybe before we get into anything. I guess the truth is probably I've spent most of my career accidentally collecting evidence that we humans are irrational. And it's almost like when I think back when we started our life back on the buy side, sell side, stockbroking, you as a portfolio manager and etc. We can go back to some of our friends, but it's UBS, it's Lehman, it's Goldman, it's capital markets, it's helping founders, CEOs raise hundreds of millions and then going on to being companies that turn into billions before eventually becoming one of those people who are responsible for spending it. And I guess what I've learned, if anything, is markets change. Technology changes, regulations change. There's themes, there's cycles, but people don't change very much. Whether you're an investor, a founder, a consumer, a merchant, everyone wants the same thing: less pain, more certainty, better outcomes. So most of my career has simply been trying to understand how incentives shape behavior, which sounds very intelligent till you remember we also ran with the bulls in Pamplona, and that probably disproved my entire theory above.
No, definitely. And as you say, 25 years sounds like a long time, but it really isn't when you're having fun. And I guess your point is it's people doesn't change, and with the experience you have with capital markets and various asset classes, it's viewing the people really and the processes, which is probably the most valuable thing. I mean, if we switch into Zilch, I mean, that is a fascinating case study, and from the outside to me it looks like one of the few fintech businesses that's massively scaled and maintained the discipline. But to your mind, I mean, you were very close, you were very early in that business. What was the real driver of growth, and what did you get right that others didn't? I don't think it's just about growth, but I'd love to scratch into that in terms of how you got that so right.
So I guess like, if we unpacked like probably part of your question, because it's been an interesting 7 years.
Yeah,
But yeah, let's just say like I mean, just to unpack, it's almost a question of, I'd been running a business over in America, sold that, came back, and I've kind of always been known from, dyslexic, so I've always been, I wasn't the kid who answered who got all the exams right. Um, but I was a hustler, and so one thing I've always been able to do is, pretty much draw 100-page contract as a
yeah,
schematic, the old classic small circle, big circle, but the route to how this actually works. So visualization has always been something that and then connecting storytell, and ultimately, I guess from being an East London, mixed race Jewish kid born on a council estate, growing up with a mother with three jobs, I've always been able to genuinely sort of like learn the hard way, but find the right way. And it's a case of like when I came back, the one thing I knew I'd learned on the streets of New York was effectively how to remove the ego and think about it's not about you, it's not about us, right? It's about them and their outcomes, as Chris Voss
yeah,
says. And so, what's been the real driver of growth has been effectively has been if you really think about the world, costs go up, patients go down. That's been one of the defining trends of the last, 20 years, if you will. Think about it like Amazon, that reduced effort, Uber, that reduced uncertainty, Netflix reduced waiting. So if it was about effort, uncertainty, and ultimately waiting and time, the best businesses remove friction. And so you think like Peter Crone talks about people wanting freedom from suffering, and movement towards fulfillment. And that reminds you almost like as three things like consumers, investors, and merchants. They aren't that different. Growth is usually like a byproduct of reducing friction better than competitors. Amazon, if you think about it, it grew from a 34 trillion of revenue in 20, like back at the end of the first decade of this century, like 16 years ago, to over 600 billion today, largely by removing friction. And
yeah.
human beings effectively, we walk effectively like 10,000 steps for fitness, but refuse to click extra buttons online. And it's and I just I find behavior incentives really, really, really interesting. So that's been one of the real drivers of growth for understanding a product market fit.
Yeah, I mean, I saw one of your posts recently, and obviously, congratulations on the Deloitte ranking of Zilch as, the fastest growing fintech unicorn in EMEA. I mean, that's fabulous. But one of the things that resonated with me, I think, is what you said is growth can be bought, but trust must be earned. And do you think businesses underestimate trust as a competitive advantage? And how did you compound that with the financial results as well during your time at Zilt? Because that was a fresh perspective on me that you gave based on your experience.
Yeah, I think trust is one of the most compelling force multipliers in the world. And and I think when you can think about it, like with the UK, that's ultimately what we do, right? The five like letters of financial services come down to trust. It's the one thing you cannot buy, and so it must be earned. It's strange, isn't it, when you think about it, when you do a relationship and you NDAs and etc. And it's funny, humans, we go, okay, if I put an NDA, that means they won't tell anybody. If I go to a meeting and we say Chatham House, guys, Chatham House,
Yeah,
and everyone's like, oh, great, so I can say anything. It's like,
yeah,
so, but it's strange in the journey of a relationship, every epoch, every 7 years, if you think about it, you go through cycles, and trust ultimately becomes that thing where you can say something so deep that it could shame your entire life, but you can say it to someone who's almost a stranger. They don't know your family, they don't know your partner, they don't know your business, but you'll share with them. And when you do, you realize actually now you're in that ultimately that real nucleus of where you can really change behavior. And I think that's because when you have a product and you have product market fit, that's something that's been really, really baked into the whole journey of Zilch with can we get someone to not just want to use a product, but habitually use our product? And if so, why?
For listeners who may be less familiar with Zilch, the business sits at the intersection of payments, commerce, and consumer finance. The platform allows consumers to spread payments responsibly while earning rewards, creating a differentiated model that has attracted millions of users and partnerships with some of the world's largest brands. So Ryan, perhaps you can add a few seconds on the product itself and how customers actually use Zilch. I think it would help listeners who may not know the business understand the scale and relevance of the platform before we move into broader growth and behavioural discussions.
Yeah, definitely. I think with Zilch, like we have a very pretty profound but simple theory. It's kind of like based on first principles as well. And I guess we've been talking a lot about human behavior and what drives it. And I guess this is about human behavior does change slowly, and but friction actually and pain compounds very quickly. We know this. And so that's why we rush to the A&E, right? But I guess the key thing is the biggest businesses in the world, they're built by removing friction from behaviors that already exist. If we haven't already covered, I guess the key point is that Amazon, they did it for shopping, Uber did it for transport, and Netflix, well, they did it for entertainment, right? And we've seen Airbnb do it for hotels and where we do vacations. But then Zilch, we're doing it for payments and commerce. And having scaled Zilch to nearly 1 in 5 working adults in the UK, connected consumers with virtually every major UK retailer endpoint up and down the country, and partnered with companies like the very best companies in the world, like AWS, Nvidia, and for finance, Deutsche Bank and others, and then likewise for 150 million endpoints, moving from MasterCard originally over to Visa just in the last year. We've effectively had a front row seat, to if you will, to the Colosseum of what happens when friction disappears. And what's particularly interesting is that many of our most engaged customers are using Zilch daily. Now, just think about it for a second, because that's fundamentally different from a product that's used once or twice a month, and we have many of these in our apps, in our phone, right? When we do doom scrolling. And I guess the key thing then is that daily engagement creates a completely, profoundly different understanding of human habits, intent, and preferences. It's almost like an unfair advantage, but that improves prediction and personalization and outcomes, and I guess for both consumers and retailers. So for retailers, that means higher conversion, better return on ad spend, like better ROAS for the more up the curve listeners, and less wasted marketing. Think about it as 1.2 trillion of marketing that's done per year, with digital being the fastest growing, and it's all giving us signals for those products, services, and goods that we buy. And at scale, those are hundreds of billions of dollar problems across the global commerce. So we're just starting from the UK. So, but the reason it works isn't just technology alone. I guess, as Phil, our founder, often says, Ryan, it's hospitality. It's giving consumers an unreasonable level of hospitality through a product they've always wanted access to. So if you think about this, then really it's technology enables it, data improves it, and it's the customer delight that compounds it. So working from first principles, we effectively asked ourselves one question: could we use AI to help eliminate $1 trillion inefficiency between consumers and retailers? We believe product market fit happens when you remove friction from behavior and that already exists. that's really the ultimate lens that Zilch sees it from. So if look, and if we're wrong, we've accidentally built one of the largest behavioural science experiments in British retail history.
Alongside his role at Zilch, Ryan is also a co-founder of the Unicorn Council for UK FinTech. The council brings together many of the UK's most successful fintech scale-ups with the aim of improving access to capital, talent and policy support, helping create more globally significant businesses from the UK. You know, you're heavily involved in the Unicorn Council for UK FinTech. Perhaps you could go into your role, why it was founded, and the problem that you're trying to solve in there as well. And also, I think that will provide really good context when we talk about capital scaling and UK competitiveness.
Yeah, definitely. I guess, like, look, capital markets are the F1 engine, if you will, of economic growth, and IPOs, therefore, are the lifeblood of capital markets. We know, Mike, from our years over, 30 years ago, like I said, earlier, there's 100 plus IPOs. You've got one a week, maybe 2-3 a week. You and I have worked on many a week, and there's a hum, there's a buzz. But the reality is that we've seen in the last 30 years, companies, the listed stock market in the UK has halved the companies that are listed on there. We've seen a couple of hundred billion of companies disappear in value from the market here. And if you think about it, like unless we replenish if we don't replenish and we don't bring strong companies back, then effectively when strong companies go private without replacements coming to the market, it creates a void. So talking of void, there's this black hole policy engagement at number 10, if you will, and with the government. Why would that be? Because you've got hundreds of companies trying to have got a kind of a policy that they would like to put across, and that turns into dozens and dozens. So effectively, in the advent of like OpenAI coming about a few years ago, remember November 22, we effectively we thought, wonder if we could, and Phil and I were like just talking about, wonder if we could actually put together, codify all of the policies that people want, because I'm sure there's themes, right? There's themes. So let's just say hop, skip, and jump. We decided to, we thought, if you're thinking of capital markets as the lifeblood of the economy, and you're thinking of them as like the F1 engine underneath the national growth, when they're working well, innovation accelerates, companies scale, jobs are created, and pensioners retire wealthier. When they're not, everyone feels it. So the Unicorn Council was founded because effectively we pulled together a group of people with Innovate Finance, like Janine Hurt, a pioneering CEO, female CEO, who's actually just, it's got the absolute grit, and I'll call it like New York's finest export to the UK. But the Unicorn Council was ultimately founded because a group of us recognised something unusual, and that was Britain is exceptionally good at creating fintech companies. We're just less effective at helping them become global champions while retaining ownership of their value they create. And today, if you look at like the GVA and the GDP impact, that today the council brings together more than 25 of the highest growth companies in fintech, to the tune of just north of $150 billion. That's like the UK's most valuable fintechs, and including businesses such as, like, for those listeners, like Revolut, Monzo, Zilch, incredible AI businesses like Quantexta or Thought Machine, banks like Alaka Bank and Clearbank, and then through to Zilch. And so, ClearPay, you've got all these amazing companies like Walker, something's coming through, Zooming. So the fact is that, working alongside Innovate Finance, HM Treasury, Downing Street and government, our mission is pretty simple: make Britain the best place in the world to start, scale, and ultimately list a technology business. So, and that's really ultimately the key thing, is like, Britain has world-class founders, world-class universities, and more than 3 trillion of pension assets. Our challenge is occasionally getting them all in the same room before America does. So yeah, that's the kind of mission that we're going on.
So one of the themes we both live through is technological change. Every cycle feels transformational, whether it's the internet, mobile, social, fintech, AI. Yeah, from what you're saying, human behavior is often remarkably similar. Do you think we consistently overestimate technological change and underestimate behavioral change in every cycle?
It's quite a profound question, isn't it? And we're going deep, right?
Yeah. Deep as you like.
Let's go there. It's like Eddie Murphy, deep, deep, deep. So, look, I think humans ultimately, we want five things, I think, and it's certainty, it's progress, it's safety, it's belonging, it's freedom, right? And I think like I'm a big fan, but like Peter Crone talks extensively about these like deeper drivers, if you will, in our psychology. Technology changes. We've seen that in the last 75 years. We don't drive the same cars. We don't compute things the way we go. We don't turn on. We don't hit switches in the same way. And but strangely, our clothes are all the same. But it does. Technology changes, and those needs, those five core needs, they don't. Like the businesses that endure, they don't fight human nature. They just don't. They align with it. And it makes me think then with regards to likes of the other man, Steve Jobs. He said you've got to start with the consumer, with the customer experience, and then work backwards to the technology.
Yeah.
So if technology changes every year, and we see this from our iPhones and etc., we're driven for it. We're learning to skip a year, but human behavior, it changes every century.
Yeah.
Which is why AI can basically can write poetry, but people still queue for a coffee every morning.
Yeah. Fascinating. I mean, just shifting on, you've been involved with the Unicorn Council and spent a lot of time thinking about the UK's growth ecosystem, if you like. And there's a lot of negative press about Britain being held back from producing more global champions. I mean, just giving your unique view on this, do we have a capital problem, a coordination problem? We've got the talent, we've got the founders. What is your view on the ecosystem we have, and how can we improve further, in your view?
So I think maybe there's another way of like putting it with regards to when you can talk about number one, look, it's a coordination problem, period. We don't have a capital problem, right? We've got trillions of it. We've got 3+ trillion of it. What we have a wiring problem.
Yeah.
We're just simply we're not connected to the actual underlying growth drivers of a company. Let's take a step back and think about what 25 years ago when we were IPOing companies.
Yeah.
These companies could come to market and I think even Neil Shah said in your last podcast, so they can come to market like with 40 million of revenue, 10 million of EBITDA, and they could list like with like $250 million of a market cap on a 15 PE or something like that. Now, the reality actually really comes down to is, what's really holding the UK back is the UK doesn't have a founder problem. It doesn't have a talent problem. It doesn't even have like a capital problem.
Yeah.
It has a capital connection problem. And as I said, we've got trillions in pension assets. We produce extraordinary founders.
I agree.
We have like world-class universities here, a handful of the best 10 in the world. Yet historically, only a modest proportion of those assets have flowed into growth companies.
Yeah.
We create world-class businesses, but too often, in a very English way, I recently was saying that, in a very English way, we create the most amazing thing. UK is amazing at inventing things like, commerce, law, employment law. Think about like the jet engine, and then take all the way through to the World Wide Web. The fact is, in a very English way, we kind of politely give the upside away to someone else. So too often we don't probably to go and list in New York. So too often we don't own enough of the upside. Now that's not a criticism if you think about it, it's an opportunity. It's a bit like inventing football and then buying tickets from someone else to watch the final.
Yeah,
It just makes no sense.
yeah, yeah. No, it makes sense. Makes sense. I mean, just going back to kind of capital and markets. I mean, obviously, we discussed you spent your career between capital and companies. In your view, what do investors consistently misunderstand about operators? And then what do you think operators misunderstand about capital?
I think maybe I can answer in a different way. I mean, like, Britain has got world-class saving pools and world-class founders, but if the question was almost like why do they connect so poorly, the, you know, it's because incentives aren't always aligned.
Mm.
It goes back to your questions about like human behavior and drivers. It's that old line of show me the incentive and I'll show you the outcome.
Yeah,
So investors, they respond to incentives, and
yeah,
founders respond to incentives.
yeah,
Governments respond to incentives. You think about it, votes, you think about it, growth, and with
yeah,
regards to investors' returns. So when incentives align, capital flows.
yeah,
When they don't,
yeah,
opportunities basically leak elsewhere. It's like capital leak. And
yeah,
so you need a plumber. And so
yeah,
the real challenge is, it isn't creating capital, Mike. It's the challenge is directing it productively
yeah,
and predictably.
yeah,
The one basically isn't short of money. It's an
yeah,
abundance. We can see this
yeah,
now with digital and etc.
yeah,
It's just short of plumbers and
yeah,
plumbing. So
yeah.
there's an
No,
architectural issue here.
that's a very good analogy, I think, which explains that well. I mean, I'm interested in your opinion in terms of I've seen you in lots of different roles in the last 25 years, but how have you changed in the last 10 years? I've got my views, but I'd like to hear from you how you're different to what you were 10 years ago in terms of, I don't know, do you say no to things you might not have a decade ago? Have your beliefs changed given your experience? Are your habits changed? And what advice, and I remember you as a 25-year-old, would you give your 25-year-old self?
Um, shave my afro off and get over it. I'm bored. Save all of the time. And I'll get to work. Remember, we had to get to work for 6 o'clock, and then I'll be on the microphone calling out the stocks and who we're going to talk about.
Yeah, yeah,
Probably with you along the line, yeah, like going right. I'll be like, can I go sixth, please? Because I'm still
yeah,
right.
yeah,
Got full results,
yeah,
which was extraordinary, right? So,
yeah,
look, I think I'd say like if the question was like almost like what's one belief I held back then, or if I talk about like almost like my 25-year-old self, um I'd say it's probably like two things. Like trust compounds faster than almost anything else in life. You know, the best way to get what you want is to deserve what you want.
yeah.
And again, as a little mixed race, like, kid growing up in a council estate, mother three jobs, bringing up two little half brown boys, who were really naughty. Um, you know,
Imagine.
had a massive handover. That's probably why I got picked on so much. But because it flopped. But then I guess so like look, if the best way to get what you want is to deserve what you want, an old line is you have to do things that you've never done to get things you've never had. So the second really comes down to like resilience. It matters more than talent. Ease is a greater threat to progress than hardship. So every meaningful opportunity I've ever had came after uncertainties, setbacks, disappointments. Like looking back at my 25-year-old, I'd love to, you know, we've all seen Marty McFly and we're obsessed about going back, going forwards. But, and the whole theory of it, looking back, I wish someone could have like just maybe like plugged into my head to say, look, these setbacks that are going to come up, they're often the investment in
Yeah,
disguise.
yeah,
So the outcome was simply like the return, if you think, and if that sounds wise. It's only because I've now made enough mistakes
Yeah.
to have my own data set that I can codify behavior in humans. And that's why I'm pretty obsessed about human behavior and language and anthropology. So
Yeah. No,
uh,
yeah, that's
if
good.
that kind of gives you an answer towards that, then we can definitely unpack that one. I can lay down. Have you got an Eames chair or something? We can talk.
So if we go into quick fire, just a few questions, just kind of in terms of what's in your head at the moment. So what one company other than Zilch do you admire right now?
Um, Nvidia, you know,
Biggest, yeah,
not because of the chips, because Jensen Young spent 20 years building infrastructure before the
yeah,
world realized it even needed it.
yeah. No, that's a good point. Biggest mistake founders make after Series B?
It's harsh to say, but looking back on personal reflection and now observing many that I get to talk to and see through the Unicorn Council, it's confusing. It's confusing funding with product market fit.
Yeah,
I
yeah,
in a business I almost get picked on about talking about product market fit, but it's one thing that
yeah.
Phil's always been obsessed about with regards to having product market fit. I think there's even a YouTube me get banging on about it. But the reality is that capital accelerates whatever already exists,
Yeah,
including mistakes.
yeah, yeah. London IPO, New York IPO, or stay private?
It's a very good question. I think there's also an obsession about where, how. Yeah, if we just talk about capital, I'd say look, whatever create, the UK's got stock market was born here, and we know that it's a handful of trillion market here. It's 10x that over in the States, but ultimately, there's differences of you got to go all in whether you're trying to do something big or small, you got to go all in. And I think, but it's just there's hope ain't a strategy and a plan ain't a strategy either. So you got to have the right people and people matter. So whatever creates the most value for customers, for the business, for employees, for the team, and for the shareholders, they're not mutually exclusive. The market is a tool, not the objective.
Well said. What's the most underrated competitive advantage in your mind?
Wow. Wow. It's actually a really good question. Really good question. I would probably go back down to um I'd probably go down to trust.
Yeah, yeah,
Founders often think capital is the fuel,
yeah,
um, but investors think capital is trust. Money follows confidence. You know this
yeah,
when you're sitting in a room and you're talking to someone, you can
yeah,
tell if you're confident, right? And
yeah,
so money follows confidence, and
yeah,
confidence follows execution. That's why
yeah.
the best fundraising strategy is usually building a better business.
And the
Uh,
most overrated trend in business today?
Features pretending to be businesses.
Yeah.
So the reality is we've never had more founders scaling businesses than we have today. In the
Yeah,
last 5 years alone, you've seen 100 unicorns be created in the UK. It took 20 years prior to create 100. So we've got over 200 unicorns here. But if you think about it, they're all founder led. They don't have the CEOs, the industry CEOs. They've got founder CEOs. So now, if you think about that concentration, you have to consider if you are a founder CEO, if you're the driving force behind the business, do you really want to be going doing 90 days worth of marketing in that you haven't got to go and talk to investors and reassure them that everything back at the ranch is just fine? If you go to America, do you really want to do the quarterlies where effectively you got to then bring on you got to do federal filing and etc. But great, the risk could be worth the reward. But reality is companies are staying private for longer, and we can see that just in the likes of now what we've got with Anthropic and etc. Companies like Anduril, the defense company over in America, Databricks, Stripe, or companies over here like Revolut, Monzo, OakNorth, Zilch. So all these companies, they're delivering, rule of 50 and above. And yeah, at the same time, if you look on something like the FTSE, the Unicorn Council companies, which are now worth like towards 200 billion. Think about that. That's $1 trillion at scale in the next 5 years, growing overall. If you really actually factor it in, that there alone is like, worth, if you remove the top 25 companies out of the FTSE, that alone is worth nearly 50% of the entire rest of the market.
No, Brian, this has been a really fascinating conversation, and I've really enjoyed us talking about capital, incentives, technology, trust, human behaviour, and I guess that's what separates companies that ignite from those that truly scale. And I think for me, if there's one takeaway, it's probably technology changes quickly, but human behaviour changes more slowly, and the businesses that endure are usually the ones that understand both, and you definitely do, and you've lived it. So thanks again for joining us on Ignite&Scale. It's been a fascinating conversation. Appreciate your time.
My pleasure. Anytime, Mike. Take care.
Cheers.
If you want to listen to more episodes of the podcast, we're on all good audio platforms. Our website is also www.cambriaprivatecapital.com, and you can also find myself on LinkedIn and Twitter, where we publish our weekly blogs as well. Please do get in touch if you want more information.